What is an initial public offering, IPO? An initial public offering, IPO, is the process by which a privately held company offers its shares to the public for the first time. It is a way for a company to raise capital by selling ownership stakes, shares, to institutional and retail investors. By going public, the company transitions from being privately owned by a small group of investors to being owned by the general public. Key points of an IPO. 1. Raising capital. The primary reason companies go public is to raise funds for growth, pay off debt, or fund other initiatives. Second, public access. Investors get the opportunity to buy shares in a company that was previously privately held. 3. Pricing. The company and its underwriters, investment banks, set an initial price for the shares based on various factors, including the company's valuation, market conditions, and demand. Fourth, stock exchange. Once the IPO is completed, the company's shares are listed on a stock exchange like the New York Stock Exchange or NASDAQ, and they begin trading publicly. Should you buy shares? During an IPO, buying shares during an IPO can be tempting, but it comes with risks and rewards that you should carefully consider. Here are some factors to take into account before deciding. Pros of buying. During an IPO, 1. Potential for early gains. If the company is successful, buying early can lead to significant profits, especially if the stock price rises quickly once it hits the market. 2. Access to exciting companies. IPOs often involve high-profile or innovative companies. Think of tech companies like Google or Facebook when they first went public, which can offer growth potential. 3. Long-term investment opportunity. For long-term investors, buying an IPO can be a chance to own a piece of a company with strong growth prospects. Cons and risks of buying. During an IPO, 1. Price volatility. IPOs are often highly volatile in the short term. The stock price can surge on the first day of trading, but can also fall significantly, especially if the initial hype fades. 2. Lack of historical data. Unlike established companies, IPOs typically don't have a long history of financial performance. This makes it difficult to predict future growth and risks. 3. Underpricing, overpricing. Sometimes IPOs are underpriced, meaning they are sold at a lower than market value, leading to initial gains for investors. However, they can also be overpriced, which can lead to losses if the stock doesn't perform as expected. 4th, lockup period. Early investors, such as company executives or employees, are often subject to a lockup period, typically 6 months, during which they cannot sell their shares. After this period, there can be a large amount of shares hitting the market, which can depress the stock price. 5. FOMO, fear of missing out. Many retail investors buy into IPOs out of fear of missing an opportunity. This can lead to overvaluation and high-risk investments. Should you buy at the time of the IPO? If you're a long-term investor, it's important to do your research on the company's fundamentals. Evaluate the company's business model, market potential, management team, financials, and competition. If the company has solid growth prospects and you believe in its long-term vision, buying during an IPO might make sense. If you're a short-term investor, IPOs can be appealing for day trading or quick profits, but they are highly speculative and risky. The first few days of trading can be unpredictable, with prices fluctuating wildly based on market sentiment. Short-term investors need to be cautious and prepared for high volatility. If you're unsure, consider waiting a few months after the IPO to buy shares. This allows time for the company to stabilize in the public market, and you can gain more clarity on its performance, the market's reception, and whether the stock price is overvalued. While IPOs offer potential rewards, they come with high risks due to their volatility, limited track record, and the speculative nature of initial trading. It is essential to approach IPOs with caution and consider your investment strategy and risk tolerance. If you're new to investing or uncertain about a particular IPO, waiting until the stock stabilizes post-IPO might be a safer choice. Always do thorough research or consult a financial advisor before making any investment decisions.